Hey everyone, it's Rick, former investment banker, buy-side analyst and prop trader with 25 years in the game. Today I'm combining positioning, sentiment, and technicals to hunt for asymmetric trade setups. Welcome to Offsides Macro. I'd like to quickly revisit this concept of entertainment. If you followed me for some time, you know I like to troll those narratives. I began writing my Substack as a way for me to memorialize my work and thinking at the time because I knew at some point it would be valuable to look back on. This is one of those times. In early April, very simple positioning combined with other factors was absolutely screaming at us to get long risk on. And what I did just for fun was to scan the tape and podcast for narratives and headlines on or near that exact date, and here are some of them. Liquidity is breaking and the economy is next. The impending recession driven by cooling labor, housing weakness, and high equity valuations. Strategists are still leaning bearish, warning of recession risks, overvalued markets, and tariff uncertainty. And XYZ question whether tariff-induced strains and global shocks could topple the U.S. economy. If you were wrapped up in the entertainment, you missed one of the fastest and most aggressive up moves in stock market history. The edge came from recognizing how offsides the street was, not from puking the words Fed and cuts ad nauseum. You'll hear me use the term offsides quite a bit. I've written on this extensively, but consider it in the context of a sports analogy. Being offsides is not a place you want to be. Lastly, for the best experience, I highly recommend you open the deck listed in the show notes. The charts and tables that I reference will help you fully connect the dots. So let's do a quick recap on last week's highlighted markets and how they fared, and then we'll jump into where the street's offsides today. I have continued to sound like a broken record, being a broken record, but I highlighted how the equities were stubbornly offside short and the equities had another huge week. I also pointed out that the street was leaning reasonably aggressive in a flattener trade, and fading that worked marginally well. It was up about 0.6 days worth of vol. I also highlighted the softs, and they were marginally green on the week, and we'll dive a little bit more into that in a little bit with a particular focus on sugar. The continued bad observation, but still true, is how offsides the street is net short US dollar, as expressed primarily through the euro, the Japanese yen, the Canadian dollar, and the Swiss franc. And we'll dive more into that in a moment as well. So where's the street offsides today? The street continues to be offsides equities. They're also offside short the front end of the curve, US dollars, and softs. But now we have two exits from offside short in the NASDAQ and the Russell. The equities as a group climbed slightly higher positioning-wise overall, but still remain in the lower quartile. There wasn't much movement in the front end of the curve, but tens in the long bond have now entered into the upper quartile, so that pair trade betting on a steepener still stands. The energies as a group are pretty interesting. The data that we have today does in fact reflect 2 days into that recent pullback that we've had. And crude oil is actually almost nearing offsides long, and heating oil continues to be pinned at max offsides long. There's effectively no change in livestock, and that remains offsides long. And the same goes for the developed market FX, as I mentioned earlier, that just stubbornly will not push into offsides long territory. Open the deck and let me walk you through the first section here called Highlighted Markets. So here's a snapshot of where the equities are, and you can see on balance they remain offside short, and the emerging markets index is now pushed back into offsides long territory. I mentioned earlier the long bond, and you can see in the next chart that we've now entered into offsides long, and the histogram is near least short on an absolute basis looking back 12 months. The next chart here is the Dixie weighted developed market FX oscillator that I created, which I think paints a better picture on where USD exposure stands versus just using a straight average. So these are weighted according to Dixie weightings. What can I say? We seem to cap out at this level the past few weeks, and the outlier here is the British pound. And you can see in the next chart that positioning is sort of nowhere. Next, I want to talk to you about the energy complex. As I mentioned earlier, given the news of the last couple weeks, you can see that WTI is basically near offsides long and heating oil is pinned at max long. Friday, we got some headlines about OPEC extending cuts into August. Crude oil obviously dropped on that, tried to regain that level around 66s, but just couldn't do it. So maybe we get another leg lower here, all else being equal. Lastly, I think the most interesting chart of the week is in sugar. I mentioned the softs as a group the last couple weeks have been flirting with offside short. They finally managed to have a small green week on average, but I think sugar stands out the most to me and should be on your radar for a possible long setup. The next section is my full zeros and ones matrix, and you can see the June 24 column and the current percentiles based on my look back period. You can also see what positions are in the OPI, or the Offsides Positioning Index. And you can also see where CTAs are as referenced by the SocGen Trend Indicator Index. There wasn't much movement with the CTAs other than them flipping long into twos and flipping long crude oil. The second matrix here is just called positioning, and that gives you a pretty good breakdown, I think, where the groups are week over week in positioning, how they performed as a multiple of daily volatility, and where the CTAs stand generally. You can see that the CTAs continue to be long metals, livestock, and the developed market FX. Lastly, we have the OPI, or my Offsides Positioning Index. As I mentioned the last couple weeks, there's been this convergence between the OPI and trend CTAs, although I'm surprised the trend CTAs are actually not doing better given the pullback in the OPI. And I've taken a deep dive there, and their systems really need to have the optimal look back period, and they just continue to get chopped up year to date. I've also given a lot of thought to the OPI indicative exposure indicator that got us long risk on below 5,400. And I nerded out a lot this week with VAR calculations, and I'm considering setting some caps to the exposure there across these four buckets. Again, the goal is not to create a tradable system, but instead to create an index for us that just doesn't exist and that can give us a look into how fading offsides positioning is doing. The genesis for this whole thing and caps is really primarily driven by the outsides moves in the last several weeks in the NAV due to the currencies against the US dollar, because you can see in the zeros and ones matrix that they all just continue to pile up into the offsides long almost across the board. But I'm not totally decided on what to do there. Any thoughts on that are definitely welcome. The last few months, I've given us a percent position indicator for specific categories like risk on, risk off, USD, etc. But instead of doing that or showing you all my VAR adjusted exposure levels, because those can be nuanced, right, based on confidence levels and Z-scores, but I've decided to give each of these qualitative signals instead. The biggest standout, looking at positioning across all asset classes, continued to scream at us to be net long USD and net short BCOM. But I want to point out how over the past 2 to 3 weeks, the risk on, risk off indicator slowly started to trend towards neutral, as I mentioned last week, and is actually now suggesting an overall moderate risk off. That's a big change over the past couple of months. I'll note that that is certainly at odds with positioning in the equities, but that's only looking at equities by themselves. I've calculated an implied risk on, risk off versus S&Ps for every instrument in the OPI and have correlation and beta adjusted those to give me like an implied risk on, risk off. And this is just what it's telling me. But just remember that a net short position, for example, in long bond actually equates to X% risk on in the S&Ps. I've applied this across all assets in the OPI, so that's the way it's calculated. I know correlations break, but we have to work with what we have today. We have to calculate an aggressive VAR, and of course, always have great risk management in place. Thank you for coming to Offsides Macro. The views expressed are my own and do not represent the views of any employer or affiliated institution. Nothing discussed should be considered financial advice. This content is for informational, educational, and entertainment purposes only.